Some people were expecting a Fed rate hike in September. That's off the table now, and the Fed will have to press ahead with their first rate hike in December. Michael Pearce, Capital Economics. Following Janet Yellen's speech, global markets have been bracing all week for the US job data release. What can you tell us about this release and how will it affect the global markets?
Well, the context for this payroll release was Janet Yellen's comments that the pace of Fed tightening depends on the degree to which the incoming data continues to confirm the committee's outlook. Today's payroll report, which showed payrolls increasing by 151,000, was a little below consensus, but there were upward revisions to the past pace of employment gains. So I think it's broadly in line with the committee's view that the labour market's gradually recovering. I think that the markets responded, the dollar fell and Treasury yields also nudged lower. I think that was because the average earnings figures and average hours were a little weaker than expected. I think some people had expected that the Fed could go in September. Markets were pricing about a 30% chance that the Fed raise rates in September. I think that's now off the table. I think the Fed will probably press ahead with its first rate hike in December this year, so long as data between now and then come in broadly as expected.
UK manufacturing PMI came out much stronger than expected, hinting that Brexit so far could be a win-win situation. What did this data mean for investors?
Well, I think I'd caution reading too much into any one number. In part, the rebound in the PMI is reflecting the nature of the survey question. It asks whether firms are boosting their output or reducing their output relative to last month. So it's not unusual to get big shifts one way and then the other when there's a one-off shock that affects the data in one particular month. But taken at face value, it suggests that concerns about the uncertainty of the future trading relationships between the UK and the rest of Europe are so far being trumped by the boost to competitiveness from the weaker pound. I think of more interest will be the services PMI that comes next week. That will be more closely watched because it's a much bigger share of the economy, but also it stands to gain a lot less from the fall in the pound. So we'll see to what degree that bounces back as well.
Due to poor export numbers, Canada's trade deficit widened. What does this mean for the Canada trade balance?
We saw a rebound in Canadian exports this month, but that only reverses a small part of the much larger fall seen since the start of the year. And stripping out the kind of month-to-month volatility, what we've seen is that exports in Q2 were almost 1% lower than a year earlier. And that's very disappointing given the big fall in the value of the Canadian dollar over the last few years. It suggests that the fall in the value of the dollar is not giving much of a boost to exporters at all. And that's particularly disappointing when the domestic economy is very weak at the minute as a result of the slump in the property and energy sectors. So the economy really is reliant on external demand to generate any growth. So without any further pickup in demand, I think the chances are we see the Bank of Canada delivering another rate cut to try and stimulate the economy. We're expecting the Bank of Canada to cut rates next year.
Thank you, Michael, for joining us in our studios once again. That's all for us this week at Dukascopy TV, but you can catch up with some of our celebrity interviews over the weekend. Goodbye for now.